What are stocks and how do they work? Have you ever heard someone say they own stocks or that they made money in the stock market and wondered what exactly they mean? Or maybe you've seen headlines like Dow Jones crashes 800 points and thought, should I care? In this video, we'll break it all down. What stocks are, how they work, why companies issue them, how you can make or lose money, and how the entire system fits together. Section 1. What is a stock? A stock, also known as a share or equity, is a unit of ownership in a company. When you own a stock, you legally own a part of that company. It could be a massive company like Apple or a small startup. Either way, you're a part owner. Companies divide themselves into pieces, called shares, and offer those shares to the public to raise capital. When you buy one of those shares, you become a shareholder. And being a shareholder comes with rights, like voting on major company decisions and, in some cases, receiving dividends. Section 2. Why do companies sell stocks? Let's say a company wants to grow. Maybe they want to build more stores, hire engineers, or expand internationally. That costs money. Instead of borrowing from a bank and paying interest, the company can raise funds by selling shares to investors. When this happens for the first time, it's called an IPO, initial public offering. After the IPO, those shares start trading on a stock exchange, and anyone, including you, can buy or sell them. The stock market is a platform where stocks are bought and sold. It works kind of like an auction. People bid on what they're willing to pay, and sellers decide whether to accept. The two biggest stock exchanges in the U.S. are the New York Stock Exchange, NYSE, and NASDAQ. But there are dozens globally, in London, Tokyo, Mumbai, and more. You don't need to visit a trading floor. Most investors use online brokerages or apps that connect directly to the market. Section 4. What makes stock prices go up and down? Stock prices constantly change based on supply and demand. If lots of people want to buy a stock, its price goes up. If many want to sell, it goes down. But what causes people to buy or sell? That's where things get interesting. Company earnings reports, new product launches, CEO changes, economic news like interest rates or inflation, politics and global events, even social media hype. It's not always rational. Sometimes stock prices move based on emotion, fear, or even rumors. Section 5. How do you make money from stocks? There are two main ways to earn from stocks. Capital gains, buying a stock at a low price and selling it when the price rises. Dividends, some companies share profits by paying a small amount per share to shareholders, usually every quarter. For example, if you buy 10 shares of a company at $10 each and it grows to $20, you've doubled your money. If that company also pays $1 in dividends per year, that's an extra bonus. Section 6. Types of stocks. Not all stocks are created equal. Here are some common types. Common stocks. Most stocks fall under this category. They offer voting rights and potential dividends. Preferred stocks. No voting rights, but guaranteed fixed dividends. Growth stocks. These companies reinvest profits to grow fast. Think Tesla or Amazon. Value stocks. Stocks that are undervalued based on company performance and assets. Dividend stocks. Usually stable companies that pay consistent dividends. Penny stocks. Low-priced stocks, often risky and volatile. Section 7. How to invest in stocks. To start investing, you'll need a brokerage account. There are many online platforms. Some even let you start with just a few dollars. You can also invest in fractional shares, meaning you don't need to buy an entire $3,000 share of Amazon. You can buy $10 worth. Popular brokerages include Fidelity, Robinhood, Charles Schwab, and others, depending on where you live. Section 8. Risks of investing in stocks. Stocks can go up, and they can go down, sometimes very fast. If a company performs poorly, its stock price can plummet. If the economy crashes, the entire market can drop. That's why smart investors never put all their money into one company or one sector. They diversify by spreading their money across different companies and industries. The key is to manage risk and invest within your comfort zone. Section 9. Short-term trading versus long-term investing. Some people try to make money quickly by timing the market. This is called trading, but it's risky and hard to master. Most people build wealth slowly through long-term investing, buying and holding strong companies over many years. Remember, even Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. Thanks for watching. If this video helped you understand stocks, give it a thumbs up and consider subscribing for more simple, no-fluff finance content. Have questions or ideas for the next video? Drop a comment below. Until next time.